Hey everybody, it's Marcus Wentigan with Awareness Branding Consulting, and today's video is about business banking and financial strategies that every first-year business owner should know. Again, this is a in-depth video based off our blog post, which you can find at awarenessdigital.com/blog. So I really like to talk about the financial aspects of a startup because oftentimes most entrepreneurs overlook this because they're so focused on wanting to get their business launched and get sales through the door. However, setting up your banking and your business finances and raising and having access to capital are very, very important for starting your business. In fact, when we started our first business 10 12 years ago, we wish we would have done it the way that I'm about to explain in our video. So when it comes to business banking, the first thing you want to do is research, right? Research traditional business banks or credit unions. I've never used credit unions. We've never used credit unions. We've always used traditional banks. In just a brief moment here, I'll go into the differences between credit unions and traditional banking. But for now, we currently bank with Bank of America. We've always banked with Bank of America. They have branches all over the nation. Their customer service is it's pretty phenomenal for a large bank, right? A national bank. Generally, when you're looking at traditional banks, customer service can be a little bit not the best, but we were with Wells Fargo, and it's not to bash Wells Fargo, but we would probably never do business with Wells Fargo again. And not just because they're scandals, but because we didn't have a good experience with them when we had done Wells Fargo in the past, some of us from our other businesses. We've just been very happy with Bank of America. Chase has also been very fantastic to us. Capital One, great banks. So it's about making sure that you do your research and figuring out what bank works best for you, what you want to do. Again, traditional banks offer a variety of different products versus like a credit union. The interest rates on their loans tend to be a little bit higher than a credit union. And overall, mainstream banks have better technology. They have more convenience. They're able to take care of you. They're able to take care of you throughout a lot of different areas and products versus a credit union. So when you're talking about a credit union, the really cool thing about credit unions are their loan interest rates are generally a lot lower than traditional banking, as well as you're able to influence the policies that the banks implement. So that's really cool. Like, you're a part of the bank. That's not the case on mainstream banks or traditional banks. You can't really go wrong either way. I don't have experience with credit unions. I'm not saying you should go check them out, right? Always do your research. We just tend to favor traditional banks because they have access to more capital, there's more product variation, and we're okay with paying a little bit higher percentage on loans when we need them. So on that note, we want to move into loans, right? Standard banking loans. So when you generally get a traditional loan through the bank, let's say we're going to go to Bank of America and say, hey, we want a loan for $50,000. Most of the time, they're going to ask for your income statement, how long you've been in business. Generally, banks want you to have been in business for at least 2 or 3 years so that they know that you're stable. They can see your financial transactions, your growth, etc., so they can mitigate their risk and figure out how much they're going to actually give you and what your interest rate's going to be. The national average for regional and national banks, the interest average for national and average banks is between 2.5657 and 7.1716% on business loans. Again, we're talking business loans through the company. There are personal loans that you could get out that you could put towards the business, but those interest rates tend to be a little bit higher, like 15%, 12%, 8%. So when you want to access additional capital from a bank through the business, make sure you're using your business name for that so you can have access to these lower interest rates. Okay, moving on. So we are going to talk about consumer and business credit cards. So this is a really cool topic because a lot of people think that you can't use a consumer credit card for business expenses when you can. You just have to be careful about it. The really cool thing about consumer business credit cards is they have a lot of 0% APR, 12, 15, 18, even some 20 months. I think US Bank has 20-month 0% interest APR, which is amazing for startups that need access to capital but don't want to get eaten by the interest rate, and it allows them to buy time to scale their businesses. they will only require you to pay the minimum, and you're also protected in different ways than you are with a business credit card, right? In terms of, I think it's raising interest rates, so it's like they can't just change the rate on you like you can kind of in a business card. Even though it doesn't happen so often in business, it's still, you're more protected on the consumer. I think it's from the Consumer Act of 2008, something like this, a credit card thing. Google it. And the difference between the consumer and the business is the business credit cards do offer also 0%. There's just not as many out there, but it's more the perks. When it comes to business credit cards, you have the perks for, let's say, the American Express Platinum. We had that one for a long time, and we could have access to all the VIP lounges. We do a lot of traveling for business around the world. Redeemable gifts and coupons, gas, restaurants, taking out clients for dinner and whatever. I mean, you have so many more perks when it comes to business credit cards, but you have better, in my opinion, when you're looking at a startup, you have more attractive offers on the consumer side of credit cards for financing, right? The 0%, 12, 15, 18, and 20 months. When you need cash injection, right? On a personal level, because you can swipe that on your business Stripe or Square, for example, right? Which after this we'll talk about credit card processing, and then it's a loan from you, a personal loan from you to the company, right? But at least it gives you access to that capital. Again, you won't be charged interest. Just make sure you pay the minimum payments, both consumer and business credit card, so that you can avoid canceling or nullifying that out. Because what happens is if you miss a minimum payment, they can say, hey, you know what, you didn't make your minimum payment, you are no longer able to take advantage of the 20-month 0% APR, and they hit you immediately with that APR. So really be on top of that. Okay, moving on. So now we're going to talk about credit card processors, right? We use Stripe for ours. In today's digital world, literally everybody uses a credit card processor. Square, Stripe are very common ones. There's a lot of them out there. So just do your research to make sure that you know what you're getting into, what their rates are, how it's going to work with your business. Are you online only? Do you have a brick and mortar store? Do you do both? Again, we like Stripe for what we do. We're all online with Awareness Branding Consulting. We send our invoices. They can pay online if they want to, send a check, and everything is synced and transparent. And that's very important when choosing a payment processor, that it syncs with all your accounting software, whether you're using QuickBooks or Xero and what have you. So it's very important to take a look at what credit card processing software that you want to use for your business. With that said, there's also some really, really cool startup resources. There's platforms. Again, I think I've mentioned AppSumo in the past before. I've also mentioned JoinSecret, and if I haven't mentioned JoinSecret, I am now. JoinSecret.com is a platform for resources where you can sign up and you can have access to a lot of different services, from Amazon to Stripe to ChargeBee to Money.com. Really, really great platform to where you don't have to pay any costs for 6 months or a year. For example, Stripe. We recently acquired the offer that they have for Stripe, where you can be up to 1,000 or 2,000 transactions. I don't remember. I have to look again. Don't quote me on that. Just go to joinsecret.com, check it out. And we're able to not have to pay the fees, the credit card fees, for X amount of transactions or X amount of time. So anything that you can do when you're starting up, you want to save costs when using necessary and important software. So make sure you check out appsumo.com, joinsecret.com to look for all these different deals that you can apply to that you can implement to your new business. Now, to get into the tax structures and write-offs, again, I don't want to go too far in depth with the video in terms of tax structure, right? We have a tax team, we have CPA accountants, we have great people. I just want to touch upon this a little bit because it does tie into financing and business banking. Again, make sure you check with the certified tax consultant, CPA, people that know what they're doing on an in-depth level. We have people for that. If not, just make sure you Google in your local area. Because they are going to play a significant role when it comes to taxes and business write-offs. But what I wanted to talk about was the different structures that, the LLC and the C Corp. Being taxed as an S Corp is only available for multi-member LLC companies, right? You can't be a sole owner of an LLC and be able to be taxed as S Corp. You need to have at least one other person, right? Multi-member. And the only reason that people want to be taxed as an S Corp and an LLC is because you will be taxed as an employee instead of an owner. But keep in mind that if you have any additional income coming in, that's going to be classified as dividend income, right? So you still have to pay taxes on that. We then have the C Corp, where you can have the election of S Corp or C Corp. Unfortunately, for our business structure, because we have foreign shareholders, we automatically cannot qualify for S Corp because not everybody's a US citizen. So we are automatically taxed the 21% flat rate of a C Corp. And the downside to C Corps are there's a double taxation, but again, talk with a certified public accountant, talk with a tax guru, a really good tax expert, and they will help you to avoid those nasty double taxations. Generally be looking at paying anywhere between 13.6% for a single member LLC. With two members, it usually comes up to 23.2% or something like this, 23.6%. And the average small business tax is around 13.6%. These were like the recent numbers that we saw. This is always changing, things change. It varies. Again, talk with your certified tax accountant, public accountant, a tax expert, and they will make sure to give you the proper guidance that you need so that you can figure out what makes sense. After the tax structures, again, with business write-offs, I want to talk about business write-offs. So there are certain plans in place that allow you as a small startup, as long as it's less than $50,000, or even some have different structures to where the first $5,000 are tax-free. Again, double check. There's lots of great stuff out there that a CPA or a tax person can guide you. I'm repeating myself, sound like a broken record, but I don't want to mislead anybody, and always double check with the professionals who are licensed in those particular areas. Moving on from the tax structures and business write-offs, we have how do we generate more money, right? Sometimes going to traditional institutions, interest rates can be hard. You're not in business long enough, right? Oftentimes you don't qualify for a $50,000, $100,000 loan from a bank because they want you to be in business for at least 2 years. For at least 2 years. And you go, well, how can I do that? I just started my business. So oftentimes it's the downside that you see on the traditional banking side is you're not in business long enough. You don't have a track record. They're not going to take a risk on you. So where are the alternative sources to raise capital or acquire funds? Friends and family, your personal savings, accelerator programs that provide 2 to 3 months of seed capital to help get you off the ground. You have crowdfunding, Kickstarter, Indiegogo, Razor Fund, or fundraiser, RAZR, fundraiser, making sure that your marketing is on point so that you can get people behind your why, right? Starting with your why. There are also business mentors, outside investors, angel investors. Again, there are a lot of different avenues outside of traditional banking to help you get seed capital to grow your business. Comes down to your ability to pitch, to sell, to convince, to inspire, and make sure that the people that are giving your money to you to invest in your business, that there's a high chance that you will be successful because you're doing everything right. So this is really important to remember. So those are different avenues to look for forms of funding. And last but not least, we are going to talk about bookkeeping. Just this last little brief moment here. From day one, keep your books in line. As you grow your business, as you look, again, maybe to traditional banks because you were rejected in the very beginning, you're going to need to provide accurate, transparent accounting for family and friends, for investors, for accelerators, for banks. Everybody needs to know what they're getting into if you're going to ask them for a large sum of money. So please use your Xero, use your QuickBooks, use FreshBooks, there's another one out there called FreshBooks, something like this. Just make sure that everything's on point. Use a bookkeeper month to month, or use a CPA. Again, a lot of people think you need to get a CPA to do your books right away. You don't necessarily need that. You need a bookkeeper because CPAs tend to charge a lot more. But bookkeepers and CPAs are very, very equal when it comes to knowledge, even on their tax knowledge. The thing is, to be able to do certain legal things, you need to have that sort of, that CPA, but they can still do your books, right? So keeping in mind that you find someone who's qualified, that understands that has a deep understanding, of accounting and taxing, so that from day one, month to month, your books are always up to date. So when that time comes, when you can raise that money or apply for that $100,000 bank loan, there's a higher chance that they're going to approve it, and you'll have less headache or getting rejected and stuff. Because again, we've seen lots of people get rejected from banks. We've seen a lot of people get rejected from SBA loans, PP loans, because their accounting is a mess, right? And if your shit's all over the place, then it doesn't help you, your business, and you're just gonna stress more. So Again, hopefully this video's been insightful. You can always check out our blog to read about it a little bit more on awarenessdigital.com/blog. Like, subscribe, leave your comments in the section. We'll always try to get back to you as soon as possible. And again, hopefully this video has been insightful, and we're always here if you need us. So thank you and have a wonderful day.